cash available to those depositors. They've had to borrow from the Fed. And then they're going into the market and doing this they should be doing this orderly asset sale of the bonds to generate the cash to pay back the Fed, which is
so
basically
it's just
where
musical chairs. Money's moving around, causing these problems. It's musical chairs. And if the musical chairs stop, then we don't have this problem, correct?
So if people stopped moving deposits around, then you're right. The banks wouldn't need to borrow money to give depositors their money and then go do the work of selling the bonds in the market.
Why are people moving their money around? Because of the FDIC.
It's uninsured. Because it's uninsured.
So here we go. So you just insure it and this whole thing stops. So it costs them nothing to just say that, right?
Yeah. So here's the thing, Jake, how you mentioned this case that you hear a lot of people saying, well, why don't you just take your $2.5 million and break it up into 10 accounts of
which is what people are doing. Yeah.
Yeah. Well, look, it's not feasible when you need to run a big payroll at the end of the month and you got payables. It's administratively too complicated. And by the way, what have you accomplished doing that? You haven't solved anything. So at a minimum,
who hasn't accomplished for the startup? It has accomplished. I'm just giving them prediction. The system. Yeah.
Why wouldn't you just raise FDIC to $2.5 million or have FDIC be based on the number of employees in your company or allow a higher class, a business class of FDIC that goes up to say $5 million.
Pro.
Yes, exactly. It goes up to $10 million. And in exchange, the quid pro quo has to be that the bank can't put that money in risky assets.
Why is this not? This is so obvious.
Well,
FDIC
sorry,
Pro.
just hold on a second.
Solve this whole
the reason I walked through that whole explanation is because I want to answer your question. I'm sorry it took so long, but I want to highlight that because that is what an insurance underwriter, put aside the FDIC and put aside banks and put aside the government's role.
Yes.
That's what an insurance underwriter's job would be. They would look at the volatility and the pricing on the bonds that the bank holds, and they would determine ultimately two things: probability of loss and severity of loss. And the probability is how likely is it that you end up in negative equity and that you have people requesting money and you have to sell those bonds at a loss very quickly. And then the severity is how much would you actually lose. So if the Fed raises rates by 3% and your entire book is tied up in 10-year bonds, you see a 25% decline in the value of your bond portfolio. That's as bad as it gets. If you start with a 10% buffer, now you only have 85% of the money you owe the depositors. So your loss is 15 cents on the dollar. So the insurance company would say, what's the probability of that event happening? How much should we underwrite it for? What should we charge as a premium to do that? And that's ultimately how the rates would get set. Now, the problem with most insurance models around this sort of a problem set is that these are the extreme tail events that have never happened. And so the insurance, to Sachs's point, is super cheap leading up to the extreme tail event. And then everyone's like, oh my gosh, we underpaid for so many years. We didn't realize how severe the losses could have been. We didn't realize how significant this was going to be. And as a result, you now see this kind of multiplying effect because people are like, oh my gosh, if it happened to them, it could happen to me. Let's all sell. And it gets worse and worse and worse. And so, the real rate for the insurance going forward will now have to take into account this massive risk. But the game theory problem is, as Sachs has pointed out, if you just insure everyone, the cost of the insurance actually goes way, 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 way down. Because now you don't have this money movement problem. And so, the point is, the more you insure at this point, the cheaper the insurance will actually be if you're an actuarial or free market underwriter, free market kind of, underwriting process on this thing. Because now the probability of having this bank run goes way, way down. And therefore, the cost of the insurance should go way down. And so the irony is if you actually did, and this is getting super technical, but if you actually looked at the statistical model and said, how much is this going to cost to insure every deposit? It gets much, much cheaper the higher the deposits that you're willing to insure would be. That's my sense of what the free market would do here. And it's certainly what I think the federal government should probably think about doing if they're going to continue to play a role in backstopping banks.
The net is startups right now are doing 5 to 10 banks. I'm watching it happen. They're doing all these sweep accounts. They're doing multiple accounts. So the government, if it doesn't raise the FDIC limit, is basically just creating extra work for everybody, and it's going to be the same outcome. So the street will find its own use for technology and how to hack this. And that's what's happening with these services in real time.
Just to steelman the old-fashioned view or the traditional view of this, they would say that, well, you want those startups being paranoid. You want those startups doing the work of disciplining these banks by moving their money elsewhere if they detect a problem. However, the problem with that is you get these bank runs. That is what a bank run is, in part, is people moving their money because they're fearing that the bank is not doing a good job with their loan portfolio. So this is why in the, let's call it the olden days before FDIC, we had bank runs and panics all the time. And that's why FDIC was invented. So there's a hugely destructive problem that comes along with placing the depositor in charge of disciplining the banks. And I would argue that the depositor is not the best person to do it. It's the regulator. Just to kind of layer on what Freeberg was saying, I think there's like a fundamental market failure with banking in the sense that the depositor or the consumer and the bank think they're getting two completely different things. When you open a bank account or a checking account, you think you're getting a checkbook, an ATM card, a place to do payroll, run, and payables.
It's a service.
It's a service, and maybe you make a little bit of interest, but it's not even your main motivation. Okay, that's what you think you're getting. Your money, most of all, is safe because you're not signing up with a service provider to have any chance of losing your money.
You're not gambling.
Right. But now what does the bank think it's getting? You know what the bank thinks it's getting? An unsecured loan that they can then turn around and invest in whatever they want or whatever the law allows them to.
So there's a disconnect between the parties and the transaction.
Exactly. Yeah. It's a total disconnect. And moreover, the way the management of the bank is compensated is that they only have to pay back your loan, your deposit basically is their loan at par. And anything they make on a bet that they make with that money, they get to keep. They get to keep all the upside. Their stockholders and management get to keep that.
And those incentives are what are driving this. And that's what drove the risk in all likelihood at Silicon Valley Bank. They were getting $200 billion, whatever percentage point they got, Chamath. Well, somehow the executive team was compensated for it.
Their incentive, it's not just them, but the whole banking system creates the incentive. They're highly leveraged. The deposits, from their standpoint, are leveraged. They're leveraged 10 to 1. So their incentive is to go to the casino and gamble it because they get to keep all the upside. And if they lose it, it's basically someone else on the hook.
Final word, Chamath.
In early May, the Fed will release their investigation into Signature Bank and SVB.
Okay.
Powell said that this week. I think it'll be really interesting to see how much honesty they both put into the report and then whether the entirety of that report is made available to the rest of us to read. But I think Sachs has very elegantly summarized what's happening. And it doesn't take a genius to figure out that this doesn't make sense. And so the question is, what is the tolerance that we have for changing something that clearly is mischaracterized? What consumers think they're getting and what banks are then doing are two totally different things. And if the Fed actually is really, really honest and really lays bare everything that happened, it'll be very hard to not legislate changes based on it.
And your best swing at